Today's episode is brought to you by Treston Associates. Treston Associates provides a growing suite of back-office services to mortgage brokers. One of their most popular services is mortgage fulfillment. Treston Associates will handle the fulfillment of your files on a per-file basis. No monthly fees and no commitments. You have a team of experienced professionals working for you without the headache and expenses of payroll, training, and turnover. Get in touch with Treston Associates today by visiting their website, tresstonassociates.ca, and book a call for a fee evaluation of your business. You can also click on the link in the description. Treston Associates is helping mortgage brokers scale their business. Contact Treston Associates today. Welcome to another episode of Real Estate Tribe. We are your hosts, Harris and Umar Zulkarnain. What's up, Umar?
Nothing much. I'm excited for another episode, or I guess.
Yeah, it's, you know what, another episode, another day. We've got a lot of interesting things to talk about, but the thing is the industry is constantly changing, especially the last 6 months. And it's been something that it's spooking a lot of people, and it's also, there's a tremendous amount of potential for people operating, professionals, whether they're realtors or mortgage brokers operating within the industry, to take advantage of. Speaking of which, today's top tip is focus, and we're going to be elaborating more about that later on in the show. But to kick things off, Umar, what do you have? What's our first topic?
We have a few topics. I think today's episode is really relevant in that there's a lot of kind of big numbers coming out every month. A lot of headlines that stoke fears. So it's a good opportunity for us to really look at those numbers, look at the information, what's going on, and then discuss advice, practical advice on how to understand and navigate these changes going on in the industry. I know every time I log in, I'm going through the news and I see headline after headline, someone saying, "Oh, the real estate market's crashed, it's crashing," or this is just
There's a lot of doom and gloom.
Yeah.
Sky is falling, everybody run for cover.
So the idea is just kind of, let's look at that information, let's understand it, and maybe there's more to it than just selling clicks, because that's often what's really happening, right? Getting that attention from the broader market. So last in 2021, I don't know if people know this, but compared to the numbers were released for July 2022, and compared to July 2021, we saw a 47% decrease in overall homes traded. So what does that mean? We had about 10,000 homes sold in 2021 in July, and we had about 4,800 or 4,900 homes sold this year. So you had a dip. That's a fact.
Yeah, so, I mean, I guess the topic then is that the sales are plunging. And one of the biggest things that I when I look at these numbers when they're going down is, was 2021 a typical year?
No, it was not.
Yeah. So
every year is not a typical year lately, I think.
Yeah, past 2-3 years, everything's kind of been like weird, and it's hard to kind of understand what the baseline is. And so you're kind of measuring something off of something else that's constantly moving, and sometimes there's spikes, sometimes there isn't. I do remember, for example, I know this is dropping, and I'm kind of segueing a little bit, but I want to kind of preface this with this conversation about sales dropping. And that is that I remember, I think 2020, when there was, I think, the lockdown first initiated. That was the first year. March of 2020 was when lockdowns initiated. And then you had like some crazy numbers in like September that came out. They're like, oh my God, we're like 50% above the September of last year. But if you look at it, if you look at the entire year, it's been like there was no sales. Sales are below market the entire from like March all the way to August. And in September, there was a spike just because there was some pent-up demand. And even though September, normally numbers go down, it went up, but it didn't compensate for the previous months. So you had these insane, like, oh my God, things are going up. And then the next year, people got more comfortable with the lockdown. They actually went out and started spending that money because there wasn't the fear of 2020 lockdowns, but you had 2021 interest rates, which were like amazingly low. We've got like 1% I think HSBC or one of the banks had some put out like 0.99%. So there's an insane drive for sales. So 2021, I would argue, was a year where there was a lot of activity. No.
Yeah, and I think what happens also is you have these peaks and valleys, and when numbers are reported, the numbers don't really account for the difference in types of inventory, types of buyer. So you had a lot of people buying in 2021, a lot of people coming out and saying, hey, it's a good environment, we should start buying now. And then that had exacerbated further what happened now, where you have less purchases happening, but the price differences that people are seeing, they're not really accounting for the type of houses being sold. A good example is, I forget which newspaper it was on. There was something, an article I read about how they were reporting King City housing prices dropped by 80% or something. It was something ridiculous.
Yeah.
And then if you look into they did not report the data, but I got a little curious, so I looked into the data behind the difference. And the last year's the inventory that was sold in King City were estate homes, and it was, I think, maybe 15 homes that they were looking at in a particular region that sold for over $2 million, 2.5, something like that. This year you had maybe 3 homes sold so far in that same area, 4 homes that were considerably smaller. I think maybe 60-70% of the size.
Yeah.
And then they're comparing that overall sale average price to a completely different product, which makes no sense.
Yeah, I mean, if you want to create a model, you could always create a model that says there's doom and gloom. I mean, we're not in any way saying that the market isn't being affected, but I do feel that the market is being affected, obviously, because interest rates are going up. But then you have all these models that are coming up to make it even more sensational than it really is. I know that I think it was, again, 2020, a lot of things happened. Summer 2020. I think at the end of it, the condo market had been affected in the GTA, specifically Toronto. I guess not the GTA, but Toronto, and prices had gone down. And I forget what the number was, but I feel like it was nominal, like 0.9 or 1 or 2%, whatever it was, right? And that made headlines. But the reality was that there was some laws changed, and it was to do with Airbnb, and you couldn't just set up an Airbnb anywhere. And because that happened, a lot of investors threw their property on the market, and you had something along the lines of like 2,000 to 4,000 extra units above average. And if you take that into consideration, that 1% dip was pretty good. If you take into account that, you know what, you had an extra 4,000 units being sold. So I think the same thing is kind of going on here, where, okay, so you had we came out of a year which was exceptionally strong. People were bidding, people couldn't get homes. There were like 70 offers the first weekend a house goes on the market, and then you have to go in with no conditions, firm offer, hoping and praying that everything works out, to a market where interest rates have gone up, people are qualifying for less, which naturally means what? It means that in order for you to buy a particular home, that same home that you would have bought last year, you now have to save up more money, okay? So does that mean that life events have stopped happening? Not necessarily. It's just that you have to save a little bit longer before you can qualify, or you qualify for less, so you're going to wait, essentially, until you can maybe get into the home that you want.
All right, so the next topic, so there's been some interesting data also going around about the types of buyers that are participating in the market now, and the changes in the, I guess you could say, demographics, or the buyer that's more actively participating. So Canada's mortgage boom is almost entirely uninsured investors. So what does that mean? So you have less first-time home buyers coming into the market. You have less people that do not have the requisite capital to put in that down payment, and it's people who are investing in properties that are more actively participating in.
So when you say mortgage boom over what period of time are you referring to? Is this something that is this year, or is this something that has been happening over the past few years?
It's been increasing. The data showed that in May of this year, the outstanding balance of mortgages in Canada reached 1 trillion. So the amount has been increasing over time. But what's been changing is there's been more participation with one segment of the market taking a greater share of those mortgages as opposed to other segments. So the first-time home buyers are not increasing at the same rate as the uninsured investors that are buying property. And I think it is in line with just you could say buyer habits, in that when you have these kind of downturns, you have the investors that are thinking, okay, this is an opportunity. This is not something to be scared of. This is the time I can get into the market at a cheaper price with less competition. And then hopefully within the next couple of years, the prices start increasing at the same rate or just continue to appreciate, and they're able to make more profit because of the downturn.
Yeah, I also think it's a lot to do with fear. So if you're sitting on the sidelines and you're waiting, and you're a first-time home buyer, obviously buying a home and making that decision is a big thing. But if you're an investor, you kind of understand that, hey, I can easily refinance this, go pick up another property, and then you're seeing that the appreciation is pretty good. Interest rates are going down. There's a lot there that can help you. And so if you buy a property in 6 months, a year down the line, you can refinance it. And with that extra cash, you can go pick up another property. Why not?
Yeah. And I think that's what usually the investor focus is, looking at that longer term. I think there were some reports about some investors targeting 2024 as, okay, we're going to have a continued downturn or maybe a stabilization of the market. So get in the market now, and then around that time, the economy will more stabilize, and then you'll have that 10% or more increase coming back. Again, it's always speculation. Obviously, a large part of it has to do with how the interest rates will change in the coming months and years. What are your thoughts on that, Harris? Do you think we'll keep having a reduction or increases in interest rates, or?
I think it's difficult, and I've spoken to a lot of brokers about this and realtors, and it's at this point, it's very hard to say what's going to happen. There's a few things that are involved, and when I say a few, it doesn't mean that it's simple. There's a lot of complexity behind it, but there's several different variables that dictate whether the interest rate's going to keep going up or not. One of the first things that's going on is that inflation is an all-time high, right? However, I refuse to believe that just because inflation is an all-time high, we're seeing these kicks in interest rates. Because if the States was not raising interest rates in coordination with us, our dollar naturally would become stronger. And if our dollar becomes stronger, it weakens exports. And if it weakens exports, our economy kind of goes down. So there's a lot of issues that kind of are developed as a result of that. So I do believe that it's inflation. In Canada, there's also inflation in the States. States is also looking at raising interest rates, and they are. We're raising it. We're maybe raising it a little bit more aggressively, but we're in line with the same thing, because a lot of people don't understand that interest rates affect a lot of things. The Bank of Canada rate not only affects their lending rate, lending in terms of mortgages, but it also affects your currency conversion and how strong your dollar is. So if you have a high interest rate, people actually will then put money into your economy because they could get more money off of investing in government bonds and whatever it is. Whereas if you have a weaker one, it's not as promising. So when your interest rate goes up, people want to come into the Canadian dollar. Naturally, it'll become stronger. That's what I'm talking about. So there's a lot of things here, but I don't think that this is going to be sticking around a lot longer, just because in the States, there's a lot of argument back and forth about like whether the States is in a recession or not. I mean, the way they've defined it for the past 50, 100, forever years is if your economy contracts in 2 consecutive quarters, you're in a recession. So, but now I think the Biden administration has termed it as, hey, we're more in a technical recession, but recession has a lot of other things involved, because not just a contraction. You need to have a tightening labor market, all this other stuff. I do believe that the labor market is tightening because in the States, I think the argument is, hey, listen, we created more jobs last quarter and more people got hired, so the labor market is good. But if you look into it a little bit, looking into look into it with more depth, you'll see that labor market, yeah, more jobs were created and more people did get hired. However, um, you also had the labor force participation, like the amount of Americans who want a job or who are currently working, it remained the same, right? So and at the same time, your unemployment rate stayed the same. So what does that mean? It means that the same people that are working are getting more jobs. In order for those other two statistics to stay the same simultaneously, it means that people who are working are getting more jobs, which means that you have a weakening labor market. Means that you have to get more jobs to get to make ends meet, and also um, you have a record credit card debt as well. That means also again that you have a weakening market people can't afford because of inflation. So I definitely think that we are headed toward the states are headed toward a recession. They're going to be bringing down rates. If they're bringing down rates, Canadians are bringing down rates. And so I do feel that I mean some analysts will say it's going to happen Q4 of this year. I don't necessarily think so. It's very difficult to, I guess, turn around that quickly, but it's going to happen because I do feel like, okay, I think it was 2018 when the Federal Reserve tried to tighten the market, and they went from QE, which they were doing for a pretty long time, to try to raise interest rates and try to, I guess, tighten the monetary supply, and everything turned around. So the market started going down, and they immediately turned around themselves. So they started, and COVID was kind of a blessing in disguise because that was a reason for them to kind of bring back QE and lower interest rates. I feel like we're headed towards the same situation. Q4 this year is going to be difficult, but I definitely think by Q1, Q2 of next year, the Federal Reserve is definitely bringing down interest rates. If they're bringing down interest rates, I do have a feeling that we're going to be bringing down interest rates as well.
Interesting, but then wouldn't you say that they reverse course, like you mentioned, for in 2018, they reverse course by the end of 2019 because of COVID, and now it's a different environment, so there's no triggering event unless we hit a recession that they can't really get out of. Do you think there's a possibility that we increase interest rates not too much to put too much pressure on the economy and then ride it out at kind of a mid-level course?
No, because a lot of these decisions, that would be the ideal situation where, yeah, you have to make some tough decisions. But I don't think that's going to be happening just because at the end of the day, a lot of these economies are political, and we're moving more towards people kind of basing their votes on what's happened last quarter to them in their personal lives. And as we move towards elections, we are going to have to turn that around. So I definitely think that ideally what would happen is here's the problem. We don't have a supply chain problem. I mean, not only is it a supply chain problem, but it's not a supply chain problem. I know inflation, everybody's like, oh my God, the prices of things are going up. I think that's a really, it's a misdirect in a lot of ways because price of things going up doesn't mean necessarily that, hey, now something is worth more. It just means that the cash that you have in your hand is worth less. That's one meaning. The other thing is there's just not enough things being produced, right? So if everyone's sitting around in an economy for 2 years and they're just getting paid money, and I know people think that money is what you need to buy things. No, you need to have things being produced and then the money to follow to be able to purchase that thing. So now everybody could have $1 billion, but there's nothing in the economy to buy. That $1 billion is useless, and anything that comes up is going to be worth a lot of money, right? Because and it's not going to be worth a lot of money because it's worth something. It's because the money's worth nothing. Same thing in our in the North American and the Western economies now is that there's been no production. If you're sitting at home, and I know Serb felt good, and it did help a lot of people, but it also meant that you're not producing anything, but you're consuming. So who's producing ultimately? You need to have that, and so that is a misdirect in that like there's not enough production. Ideally, what you'd want is to get people to start working again, right? So now you gotta like as a lot of people sat and they earned without necessarily doing anything. Now you have to earn or you have to produce so that you make up for what you consumed in the past year or two and then some, and what you're producing currently, right? And if you're a prudent investor, you'd want to produce so that you produce more than you're consuming so that you're kind of stocking up for the future. So there's a lot of things involved here, and I think that inflation is a misdirect. And ideally, you would want inflation to go up. To be honest, the way the monetary system works, when the government is putting financial assets, when I say financial assets in the market, when they buy bonds, they are putting money into the economy. So you can produce a bond. The government could produce a bond out of nowhere and then sell it to the Federal Reserve, and they monetize it. That money goes out. And so in order to increase the interest rates, you'd bring all that money back in. You actually sell those bonds and then get that financial financial instruments in. That's one way. The other thing was what recently happened was you had a lot of money being given directly to citizens. In order to contract all of that, you need taxes to go up. And now taxes to go up the same way as same time as inflation is going up is going to be difficult. But inflation is the tax. So if you don't tax it, then inflation is going to get taxed, right? Because there's only a certain amount of products, and if everybody has $100 or $1,000, they're all bidding for that thing. The number is just different, and I think that's the biggest issue. The fact that we don't really understand, and we definitely need to increase taxes, and then make sure that we're producing and we're getting back to a stable state economy, and understand that our economies are not money. Our economies are what we produced. Money is just a easier way for us to trade what we have created.
I think there's two issues there too, though. Increasing taxes, I don't think. I mean, I know recently the Biden administration passed a legislation that significantly increased the number of IRS agents, I think, in anticipation of a tax increase. And I think that relates to maybe anticipation of a need to increase taxes. But at the same time, you have massive unionization efforts, massive, I think it's the first time in like 50 years, U.S. railway workers are in protest for increasing wages. So it's a big deal. These things are happening because people are seeing inflation and they can't afford their day-to-day expenses. And if you increase taxes in that environment, you see more of what has been happening, where you have people just walking off the job and thinking, okay, I can't afford my life. This is not really helping me. If my cost of living is $5,000 and I'm making $1,000 at this job, what's the point? Yeah. Right? So that's what we're kind of seeing. And on the other end, I think when it comes to inflation right now, what we're seeing in Canada and the U.S. as well, I'm talking about the everyday person. What they're experiencing is, at the end of the day, you could say that the value as measured in dollar terms of any good, you need more dollars. So that's inflation, but really the value of the dollar is decreasing. That's why you need more dollars. But everything is not proportionately increasing. So you have inflation in varying amounts in different places, which is confusing for people. Because if you see a car appreciating 20%, 30%, 40% in value, and then your, bread is 20, 30% more expensive, whatever it is, the difference is not proportionate, then you think that's an investment, right? You think, oh, okay, that car is actually making me more because I can buy more of this other stuff with it. And then you have more participation in those segments of the market, which makes it worse too. At least that's an assumption on my end. But I think in terms of the experience that people are having, there's nuance there, and there's a lot more involved that could change in the next months, years, and it could also change how the government responds to how people's spending habits and their lives are impacted by these decisions. So moving on, BMO released a report. I think there's a few interesting facts in this report that I wanted to talk about today. It was related to the real estate outlook. So again, topic we had initially about the doom and gloom, and the BMO report released. They revised lower forecasts for the Canadian real estate market. And their prediction is that right now we have not seen or experienced the extent of this decline. And they are anticipating a 21% decrease from the peak in Canadian housing prices. What do you think of this?
I mean, I don't know where they're getting that number. I don't know if it was BMO or somebody else who had an interesting model where there wasn't a shortage of supply, and I know from what I remember, looking at that model, they hadn't taken into account the immigration coming in, and so they're like, oh my God, well, there's enough houses for the households being created, and therefore we're fine. There's no shortage, and therefore the prices are going to go down. I don't think. I mean, it's very difficult to say whether prices are going to go down 20%, 30%. I do feel like right now they are due for correction. And this is not a bad thing for real estate professionals, but they are due for correction. And the reason being, how often, like how many properties, right, can you buy and then cash flow, right? It's very difficult to have properties that are cash flowing unless you put in an enormous amount of a down payment, right? And a lot of people felt like, okay, well, the market's going up. I'll put some money in from my own pocket and capture the capital appreciation or whatever it is, and then it'll be even. I'll be out ahead. I think that that is something that plagued the market. I had seen offers placed for, you could say, investment properties. Investment properties, I would say, are a little bit more reasonable than you have residential properties, because residential properties is emotional. People get very emotional. They're like, oh my God, I need to have this house because I need my family and my significant other, whatever. We need to live here and all that stuff. Residential properties are properties that are you're buying it based off of the cash flow. And a lot of times I saw offers being placed, which I thought was I didn't agree with it. Obviously, it was not my place to comment on any of this stuff, but I saw that you're buying a house. Let's say you're doing a multifamily. There's 8 units, right? This previous investor bought the property so that they can renovate and bump up the rents. Now, what ends up happening, out of the 8, maybe you've renovated 6 of them, 2 are outstanding, 3 of them are vacant. But what's the price? They price it so that it's like, okay, well, you know what? Pricing is, if it was fully tenanted and if it was fully renovated, and if it was everybody was paying top dollar, this is the hypothetical income. It has nothing to do with what it was really earning. It's a hypothetical number. And from that, I'm going to give you a 5% cap, which doesn't even account for, doesn't even account for all of the expenses. So, 3.5%, whatever. The actual cap could be 2%. If you really, and then you're selling it off of this hypothetical, and you have buyers because they're like, all right, you know what? Maybe I'll get close to it, but then it'll appreciate more, and I'll sell it again, and we'll be fine. And it's like you're playing a game of who's the biggest idiot. Who's going to be the last person holding it before the market starts going down? And I felt like there was too many people that were too confident that everything's just going to keep going up to make these dumb decisions. And those decisions have to be pulled back, and so that people are buying the property for what it is. It's not about what the hypothetical number is. I remember watching a video, all right, of this really famous real estate investor, Manny Koshbin. I think he lives in L.A. or
Yeah.
yeah. And so he's like, you know what? There's this one property. He made something around like $15 million off of it. It's a pretty big real estate office building. And he's like, every single time the recession or whatever, the market would go down, people would stop, like the renters would leave. He would buy it based on the cash flow, and then he would hold. He'd fill it up with tenants, and then he'd sell it again. And then when the recession would happen, because the owners would not be able to hold on to the renters, he'd buy it at a value again, fill it up again, and sell it again. So that was his kind of method of making money. But the money came from what was being rented out. He did not pay a hypothetical. He could not make that money on hypothetical money. Hey, well, listen, I'll sell you this office, but the office, like, you have to pay me on this hypothetical 95%
Occupancy.
Yeah, occupancy and 2-3% cap rate, and that's what you're gonna give me. That stuff is like just unreasonable, and it's good that all of that stuff is being flushed out of the market, because that's a lot of garbage.
And especially, but I mean, at the same time, I think there's two competing forces. You have this really low cap rate, especially for Toronto properties, and then add to that the fact that the prices were increasing year over year, and people were thinking, okay, I'm going to make my money off that appreciation, and it's okay if I'm spending a little bit every year. The appreciation is so significant that I'll still make a ton of money at the end of the day. But now what's happening is you're seeing a stabilization of prices, but at the same time, at least on the residential side, rents have skyrocketed, right? So rents, it's headline news again and again, people bidding 10, 20% over list rates, increase in rental rates. I don't think this is a permanent situation. I think this is a temporary phase. But at the end of the day, it does have an impact on your cap rate. It does have a temporary impact on demand. So if I own a 5-unit residential building and my rental income increases by 10, 20% annually, despite this turbulence in the property market, I benefit from that. Or at least my property value maintains, because I had priced in higher valuation to begin with, so I don't have as much of a loss as I otherwise would have.
Yeah.
So I thought that was an interesting dynamic. So back to the report too. So there's a few pieces of data that they use, and I just want to tackle this information or look at the data that they used to just see what your thoughts are. We can look at what the kind of competing forces are in terms of understanding that data and whether it should indicate what they're saying it indicates. So they said 21% decrease. One of the major indicators they said for the decrease in the predicted decrease in property values was days on the market, and they used IBM's AI platform to assess the data, and they were looking at that they assumed or concluded a strong correlation. I think this is a commonly used metric for the real estate industry generally anyways, but they assumed a strong correlation between days on the market and future price drop, not current price drop, in the future. So that means that as you have this increase in days in the market, in the next 6 months, next year, you're going to have considerable drops in volume or in price just because no one's buying. What do you think? Do you think there's a correlation between days on the market and the future state of the real estate market?
I think that days on the market definitely like gets people antsy, and they start thinking, well, what you're going to see is actually what happened. When you have to sell, you're going to bring down the price, right? And then when you can hold on, you're going to delist. And we had record delistings in July and June. So
that was their second data point.
Yeah, so there was record delistings. People are like, all right, and went up like, what was the number, like 6-fold or 3-fold or some crazy number since January of this year. And so you're gonna have two options, and that eventually will change the market. The thing is right now the market has a lot of different expectations. Some people are like, you know what, there's market's just temporarily down, we're going up. Others are like, it's permanently going down, it's going to go even further down. There's people who have hope and they're going to hold on. Some people are like, get rid of this. Some people who like want to get the property they want now because they feel like this is the cheapest it's ever going to be. There's a lot of things going on. Whereas you could say that last year, more or less, the market sentiment of the people participating in the market, not the ones who are on the sidelines looking at it, was more or less uniform in that, man, this is going up. I got to get it before it's gone. And so now, because the waters are kind of dirtied up, the only thing that will make the dirt settle in the water is just time, so you could see what's really happening. And so I think that as a it's very difficult to predict whether it's going to go up and go down, because the thing is again, interest rates goes up, people need to save more. Those guys aren't out of the market. People still want to buy houses because you know that rents are going up. The same people who want to buy, for example, first-time home buyers, they're paying rent, and that rent's going up because the property that they're in probably has a mortgage, and that mortgage interest rate's going up, so they're going to be paying more rent. So maybe now they even have more of a motivation to save money and get out of there as soon as possible, because, hey, even though a house price could be going down and it could go down further, here there's no, but it'll come around. With the renting, it's just going to keep going up. So, and you're losing money. So there's all these other sentiments that'll take time to figure out whether prices are going to go down or is going to stay down. But right now, it does seem like I don't know if prices are going down. I hear that like, oh yeah, $100,000 down for GTA homes or whatever. My feeling is prices, like if you take some obscure statistic, yeah, prices are going down, but if I feel like more or less prices are being maintained. I don't think people are willing to sell for less than what they bought it for. That the loss comes from the transaction cost that they may have placed into the property, but I don't think people are selling for less than what they bought for.
Yeah, I think I agree. I think days on the market is not necessarily an indicator that prices will fall. It could also mean that prices aren't increasing as fast. It could also mean that prices are not changing. It could mean a number of things. It just means that you don't have as many people coming to look at these houses and bidding on houses, and it's taking a little bit longer to sell. But it does not necessarily mean that in the future you're going to have a drop in prices. We could, but at the same time, I don't think there is a correlation there between those two pieces of data. On the other end, I think what people had gotten used to over the last few years was that even if it's a house that you're living in, you buy a house, you get 20%, 30%, some ridiculous return year over year, and then you upgrade, and then repeat and repeat and repeat. And when that's not happening, people aren't thinking, okay, I can't upgrade as quickly as I could have in this heated market, so I'm just going to sell it at loss. Like you were saying, what people are thinking is, I'm just going to live in my house, right? This is my house. This is where I'll stay. I think there was a TikTok where someone was they were interviewing people in Toronto, and they asked this guy, do you own any real estate? And he said, oh, I own my house. And they said, oh, what are your thoughts on the real estate market? And his response I thought was good. He was saying, I mean, I don't really look at it as much because to me, I bought my house. So I'm paying my rent to live in my house. The market might go up and down, but at the end of the day, I'm living in my house. So if it increases, I'm happy, but I'm not really too attached to that price at the end.
I mean, I think, the price is going up. Everybody thought their house is an asset. I mean, a house is never an asset, but the fact that you think it's an asset and that it should bring you money in is something that is kind of foolish. It's a consumption item or vehicle or whatever, because you're living there and you need to live somewhere. And if you're not living in your house, where are you going to be living? And the point of the house is, or at least I'm building some equity. I think the other issue that we've had recently, which is very bad, is that as your price of the house goes up, it doesn't necessarily mean that you're going to be rich or anything. It's now you can get a bigger line of credit, borrow off of that, and buy all this other stuff. And you can't do that now. That's a bad habit to begin with. You shouldn't be touching that anyways.
Yeah, no, I agree. And that's what ends up putting people in that position where they feel like they're forced to sell because they're overburdened with debt. And especially when you have variable rates and interest rates are increasing, they will likely be decreasing in the future, but in the current economic climate, you have increasing expenses as well for that increased debt. So the last piece of data, which I think I just wanted to conclude off with this, unless you had any other
No.
anything to also
We'll
discuss.
move to the top tip after this.
So the last thing was increase in litigation happening. So this is despite the different pieces of data going around in terms of increases in volume or price or decreases in volume, there has been an increase in litigation. There was a viral TikTok video where this individual had bought a house for 1.4 million, I think, in 2017. He sold that house for 2.2 million in early this year, so January this year, I think, with a closing date 4 or 5 months later, so May, June this year. So bought for 1.4, sold for 2.2, and then the buyer walked away. And the person relisted. They ended up selling for, I think it was 1.9. I don't have the exact number, somewhere around there. So made I think the difference overall was 500,000. So my numbers aren't 100%. I think it was 1 million to 1.6, something like that. So he made a $500,000 profit, but he lost out on an additional $400,000 from the original buyer walking away. Now what's happening? The seller sold his house to a new buyer and is now suing the original buyer for the difference and the time and the stress and all that and the legal fees involved. So you have a lot of this happening where people are going into a firm offer and thinking, okay, I'm just going to walk away, nothing will happen. But at the end of the day, that is having a significant impact in that you have an increase in litigation and you have an increase in people chasing down those buyers to say, hey, you have to buy this. I don't care if the market changed. You agreed to buy it at this price.
Yeah, I think a lot of people, what they don't understand is there is miscommunication. Oh, yeah, well, if you don't buy this, you know what, you're going to lose your deposit. And they think that's the only thing that's on the line. It is and it isn't at the same time. So let's say, for example, again, this is not legal advice, but let's say you seller lists his house for $1 million. Buyer comes in, offers him $1 million, and then puts in $100,000 down. The seller, if for some reason the buyer can't buy it, the seller relists and sells it for $1.5 million. At that point, the seller does not have any claim. The buyer does not lose his deposit. It's contrary to what people think. If the buyer does keep it or seller does keep it, the buyer can sue him, and then the seller has to prove what his damages were, and there weren't any damages because the seller actually ended up spending or getting more money. But if it goes down, and let's say they agree for $1 million, and then buyer backs out, seller sells it for $500,000, the seller is they have to be made whole. So they're going to not only get the $1 million or like that extra $500,000, they're also going to get damages for any extra amount of money spent to relist it and sell it again. And so then you could say, well, for buyers, it's not that easy, because if you don't pay that, let's say you don't have enough money and you're getting sued and now there's a judgment on you, what's the alternative? You have to declare bankruptcy, and now you don't until that's like on your credit, and I wouldn't be able to explain the financial end of it, but you have a bankruptcy on your credit history, and that's going to affect how you buy and where you buy and when you buy and who's going to lend you that money. So it's not going to be, and that's separate from the stress of actually going through the litigation and going through all of that. So it's not something as easy as we're going to step away and we're only going to lose our deposit. You lose, basically you have to make the seller whole, and whatever that requires is going to be litigated for. But yeah, so that kind of concludes our kind of topics conversation today. I think it was a good conversation, but the one thing that I did want to discuss is our top tip. And our top tip today was focus. And focus is for all the real estate professionals, whether you're a mortgage broker or you're a realtor. Focus is the number one thing that's going to bring you success in this market. When everything was going well, you had people who weren't so great at their job kind of jump into the market, and because the tide was rising, they felt like, they could take advantage of it. But as Warren Buffett says, it's when the recession hits and the tide goes in, or tide goes out, well, tide goes back, you see who's swimming without their swimming trunks. And this is that situation. And if where if you have a solid business down, you're going to be doing exactly the same stuff, and you'll know that your focus is not the next few months, but how you're going to be around the next 5, 10, 15, 20 years. And you've built your business accordingly. And so the focus, when we say focus on the things that matter, focus in on your business. You don't have all the money in the world. You don't have all the resources in the world. Everything is finite. So understand what are the things that you need to focus in on to make sure you survive this downturn. It's a downturn, and that downturn is going to end just like the upside ended, the downside is going to end. But who's going to make it on the other side is people who are focused, and they're not looking at all these sensational articles that the sky is falling. Oh my God, everything's coming down to an end. They see it for what it is. Yeah, things are coming down. This is how you're going to survive, and this is what we need to focus on. This is what my business needs for the next 5, 10 years to survive. It's not something that a downturn is going to affect as much. Doesn't mean that you're conducting business exactly the way you did it when you're when the market was at its top, but it's kind of like going to the gym. Just because you're kind of healthy doesn't mean that now you could stop going to the gym, and just because you're out of shape doesn't mean you're going to go to the gym a day and it's gonna finish. You got to develop healthy habits and focus on, and you need focus for that. You're not listening to, oh my God, all these gurus that are saying you could lose 10 pounds in 10 minutes. You understand that it requires discipline, and that discipline slowly turns into devotion. And as you do that, as you move forward, devoted to your craft, you're definitely going to not just survive, but you're going to be thriving.
Well said. And just to add to that, I think just the takeaway is when you're focused and you have that discipline, the result is consistency. So just you're making sure that you have that plan, you're consistently kind of pushing through, and results don't come in the next day. And depending on the size of your business, the size of your book, the size of your team, what you're doing consistently is obviously going to change. But the main principle is being consistent. And despite there was a decrease in homes that were sold in August or July, the fact remains there were 5,000 homes sold in the GTA, 5,000 deals. How many did you do that month, right? So that means there's volume there, is the point, right? So that with consistency, there's volume there that you can add to your book of business.
Yeah, and then to actually touch upon what you just said, focus does mean different things to different people. So if you're doing like 0 to 2 transactions a month, you're focusing on something very different than somebody who's doing 5 or more. It's going back to that gym analogy, right? If you're eating healthy, that means you're going to the gym, you're looking at form, right? When you're starting off at the gym, you're looking at form before you increase the weights. Once you've got that form down, then you're increasing the weights. And you're also looking at what you're eating, and you're not going to go from like eating horribly one day to having the best diet the next day. It's a step-by-step process. What are you eliminating first, and what are you eliminating afterwards, right? And so if you look at those two things, they are a combination of when, for example, if and the assumption here is you're going from an unhealthy state to a healthy state. When you're looking at your diet, you're stopping things one at a time and replacing it with good things. So stopping is preventing the bad, right? So with your business, depending on where you are, there's behaviors and habits that you have to stop step by step that are not good for you. Simultaneously, when you're taking on the good habits, you're again doing it step by step. You're not going to be bench pressing 1,000 pounds the first day or any day, but you're not going to, even if you can bench press more, the first step would always be to get your form down so you don't hurt yourself, right? It's the same thing with business. So those are the things that you need to consider. And I think in the coming weeks, we're actually going to go through, depending on where your business is, what we think you should be concentrating on, what you should be focusing in on, so that you get success long term, and it's not something that's like a 5-minute quick fix or the illusion of a quick fix.
Thank you guys for joining us.
Take care, guys.